Hi friends, today we are going to discuss about Indian Accounting Standard 1 which relates to disclosure of accounting policies. So what are we going to study? What is meant by accounting policy? What do we need this accounting standard for? What are different fundamental accounting assumptions and disclosure requirements relating to these accounting assumptions? How do we select an accounting policy? Means what are the primary considerations needed in selection of accounting policy and the scope of accounting standard 1 regarding disclosure of accounting policies. Now what is an accounting policy? Basically when we say policy, it means specific guidelines which are laid down to treat a particular situation or event. So an accounting policy refers to the specific accounting principles, methods of applying those principles adopted by the enterprise in preparation and presentation of financial statements. That is, when they prepare profit and loss account and balance sheet, what are the basic accounting principles and methods which are adopted by that particular business organization? Those are termed as accounting policies. So we can see in the arrows which are given accounting policy, it is specific accounting principles and method which are adopted in the preparation and presentation of financial statements. So the question comes to anyone's mind is that there are so many accounting standards which are dealing with particular business transactions and how accounting treatment should be given in any of those events. But this accounting standard doesn't deal with any of accounting treatment for a particular business transaction. So why do we need this? Oh, so why do we need this? As we know, the objective of accounting standard is to standardize different accounting policies which are adopted by different business organization. So if we want to make financial statements comparable, there has to be a standardized method of accounting. But accounting standards do not cover all possible areas. Therefore, there should be freedom for entity to select an appropriate accounting policy for those areas where accounting standards are not being mentioned. Since there are diverse situations, so it is possible to develop single set of policies for no organization. So in this case, accounting standard permits more than one accounting policy. So basically, we are allowed to use suitable accounting policy. Yeah, it's a liberty, but not exactly the thing to go haywire. Now you will think if everybody is going to keep their accounts in different ways, then where is the comparability? Yeah, if we want to compare them, then how is it possible? Oh, then see, that's where accounting standard 1 shows the right path. This accounting standard requires enterprise to disclose the accounting policies actually adopted in the presentation and preparation of financial statements. So what will happen? Such disclosures will allow the users, who are the users of these financial statements? Investors, shareholders, creditors, bankers, government. So the users of these financial statements will understand how the financial statements are prepared by different entities, and then they will be able to make comparison among them for decision making. Oh, so why do we need this accounting standard? To make financial statements comparable and understandable, we need accounting standard 1. Oh, so now you understood why do we need this accounting standard? To make the accounts prepared comparable. Now, what are the basic accounting assumptions? Basically, when accounts are prepared, financial statements are prepared, going concern, consistency, and accrual are default accounting assumptions or principle. Let's understand them one by one. What is going concern concept? It assumes that the business is normally considered to be a going concern. What does this mean? This means that the scale of operation of business continues without any intervention. That means there is no foreseeable liquidation. So, as we know in the terms of law, it is an artificial person created by law which has an infinite life. So its business keeps on going. There is no liquidation or closure or winding up as such. What is accrual concept? Accrual means as and when there is significant assurance that the revenue is earned or the cost is incurred, they are recorded in the books of accounts. Revenue items are recognized as they are earned or incurred in the financial statement for the period to which they relate. Say for example, we have sublet a part of our office premises. Now, the rent for previous 2 months is not yet received. But since those 2 months have passed on, for those 2 months the rent is payable by the opposite party. So that rent we have earned, it is accrued to us. So even though we have not received in cash, it is still to be shown in the books of account on the basis of accrual concept. So books of accounts are generally not maintained on cash basis, they are maintained on accrual basis by default. Next basic accounting assumption is consistency. By default, we assume that the accounting policies are consistent from one period to another. So, from previous years, if a particular business organization was adopting straight line method of depreciation, then we assume that the straight line method of depreciation is adopted unless there is a disclosure in the form of change in accounting policy. Okay, so do we need to disclose these basic accounting assumptions of going concern concept, consistency, and accrual basis concept? No, we don't need to disclose basic accounting assumptions because it is by default. It is assumed that financial statements are prepared on the basis of these basic accounting assumptions. So there is no need to disclose these accounting assumptions. Oh, but we assume that there is a liberty given to every business organization to use the appropriate accounting policy. So what if these basic accounting assumptions are not followed? Then what? If suppose basic accounting assumptions are not followed, then that particular fact must be disclosed in the footnotes given to financial statements. So when any of the basic accounting assumption is not followed, then it must be disclosed. Say for example, the accounting is done on cash basis and not on accrual basis, then it must prominently disclose it with clear information as how and when the revenue and cost is recorded. Okay. Oh, okay, about accounting assumptions, basic accounting assumption. But then that gives rise to a question: which accounting policy is most suitable? How do we select an accounting policy? Okay, say for example, when we want to charge depreciation, there are different methods of charging depreciation like original cost method, written down value method, or when we want to value the inventory, it may be under first in first out, that is FIFO method, or last in first out, that is LIFO method, or it may be simple average or weighted average. So how do I decide which accounting policy should I select? Oh, that is a question. So when we want to select an accounting policy, basically the primary condition, the basic objective of accounting is to reflect true and fair view of the affairs of the enterprise when we are preparing financial statements. So whether it is profit and loss or account or whether it is balance sheet, These two financial statements have to reflect true and fair view of the business conducted. So any accounting policy, when we select, it has to be in conjunction with this primary consideration that it gives true and fair view. Now, how do we decide that an accounting policy will ensure that true and fair view? So when we select an accounting policy, three basic principles which we need to follow are prudence, substance over form, and materiality. These three basic principles together will give us true and fair view. Let's go through these one by one. Now, what do you mean by being prudent? Being prudent means what? Being prudent means we are playing safe, we are conservative, we are providing for anticipated losses, but we do not provide for anticipated estimated gains profit. So, what are we doing? By being prudent means we recognizing all losses immediately, even though those losses may be suffered in future. Say for example, we know that there might be some debtors who turn bad. So even though they have not yet turned bad, still in current period we are providing reserve for bad debts. So we are recognizing all possible losses, but we ignore anticipated profits. Say for example, we know that in next year the price may rise by 10% as some of our competitors have left the market. So it gives us more market availability as well as more freedom to decide the prices, but still we will not book for these anticipated profits. We will ignore them. We will play cautious. So this basic accounting principle of conservatism is nothing else but prudence. Now, second basic accounting principle, which is substance over form. Substance means solid, real thing over form. Which form? Legal form. So the accounting treatment and presentation in financial statements of transaction and events should be governed by their substance, not just merely by the legal form. Now, substance where we talk about is real economic benefits, real economic substance. Say for example, we have purchased a car on hire purchase basis. Now the legal agreement of hire purchase says that when the last installment is paid, then only the car is owned by us, right? So suppose we have purchased it for rupees 10 lakh and it is to be repaid in 5 years. Ignore the interest, and so in 5 years we are going to repay. The 5 years equal installments will be rupees 2 lakh. So at the end of the first year I have paid rupees 2 lakh. So as per the legal form or legal agreement, I have got car worth rupees 2 lakh only. But if we find in substance or economic substance, actually that 10 lakh rupees car is we are using, the benefits are derived by us. So in our balance sheet on asset side, as per legal form, we should show car only rupees 2 lakh. But in substance, rupees 10 lakh car is with us and we are enjoying and benefiting and deriving the economic benefits from it. So we will not go as per legal form, we will go as per economic substance, solid real benefits which are derived in economic terms. So on asset side we will show car worth rupees 10 lakh, and on liability side out of 10 lakh 2 lakh rupees we have paid, but 8 lakh rupees is still payable to that creditors from whom we have purchased car. So that 8 lakh rupees will be shown under payable categories. So this is how it will be presented. So we will have substance over legal form. Now what is the accounting principle of materiality? Financial statements must disclose all material items. Now what is material item? Basically any significant information which might influence the decisions of the users of financial statement is called as material information. Now say for example, we are going for expansion purpose and in that case the expansion plans which are known, which we are going to have in the next year, must be disclosed in the current year balance sheet. Why? Because investors will be influenced by it and they will decide whether to invest in the shares of the company or not. So, any information, knowledge of which will influence the decisions of the stakeholders or users of financial statement is called as material information. Disclosure of material items is mandatory, but disclosure of immaterial items is discretionary to the enterprise. So basically, such items which are not so important can be omitted, but still it is good to disclose all the information which is significant. Now, suppose there is a change in accounting policy. Basically, one shouldn't go for change in accounting policy. But because of that change, if that change is going to give you a better picture in future with reference to true and fair view of the business conducted, then such accounting principle, accounting policy, if changed, must be disclosed in the financial statement. Say for example, earlier we were providing at the rate of 20% on computer software as depreciation, because we assume that in every 5 years this software will be outdated, redundant. Now the technology is changing so fast that we find that in every 3 years only this accounting software or this computer software will be redundant. So what we should do? We should change the rate of depreciation from 20% to 33%, or one third of the cost of that software. So this change is going to reflect a better, true and fair picture of the business conducted. So this kind of change in accounting policy is recommended, and when we change this, it should disclose the effect on financial statement of change in accounting policy, and it should be fully informed by the way of disclosure in accounting standard 1 below financial statement. Again, such change must be allowed by the statute. If it is not allowed by the statute, then it is not desirable. So, what we have got to know about Accounting Standard 1? That Accounting Standard 1 is mandatory for all business organization in India. What it says? It says that all significant accounting policies adopted in preparation and presentation of financial statements should be disclosed as part of financial statement in the form of notes at the end of the financial statement. So it is basically at the end of the balance sheet. No separate disclosure at the end of profit and loss or income statement, and no separate disclosure at the end of balance sheet. All disclosures have to be at one place, forming the part of financial statements. Basically, financial statements end at the balance sheet. So after balance sheet, all disclosures should come in one bunch itself. It is a part of financial statement. So you publish financial statement first and then come up with a supplementary in the form of disclosure requirements under accounting standard 1 is not allowed. Now if suppose there is a change in accounting policy, then a note should be given by the company in its annual accounts regarding that particular change, and it should also reflect the difference in amount because of change in this accounting policy. So basically, Accounting Standard 1 makes it mandatory to disclose all accounting policies adopted in preparation and presentation of financial statements. Thank you for patient listening.